This video describes the step-by-step process to forecasting by using Walmart's income statement as an example. Remember, the individual items on the income statement for your firm might be different than the ones presented in this example. But the key is to understand that an analyst should only forecast the income statement accounts that are believed to persist in future. This exhibit presents the income statement for Walmart for past 3 years. I have also provided you the PDF version of the financial statements for Walmart in the unit folder. All of the numbers presented are in millions of dollars. Our goal is to forecast the net income attributable to common shareholders for the next 4 years. As mentioned in the previous video, the first step to forecasting is to forecast the revenues or sales. Sales for Walmart grew by 3.4% in 2010, 6% in 2011, and 5% in 2012. The compound annual sales growth rate during the last 3 years was 5.5%. Walmart generates sales growth primarily through increasing same-store sales, opening new stores, and acquiring other retailers. In the future, Walmart will continue to grow in the international markets by opening stores and acquiring other firms, and in the domestic US markets by converting discount stores to superstores. In addition, despite vigorous competition, Walmart will likely to continue to generate steady increase in the same-store sales, consistent with its experience through 2012. Based on this analysis and using the techniques outlined in the previous video, we will assume that sales for Walmart will grow 4% each year from year plus 1 through year plus 4. Applying the 4% projected revenue growth rate gives us the following forecast of revenues for the next 4 years. The percentage of costs of goods sold relative to sales increased slightly from 74.7% of sales in 2010 to 75% in 2011 to 75.1% in 2012. Walmart's everyday low price strategy, its movement into grocery products, and competition will likely to prevent Walmart from achieving significant reduction in the expense percentage. Assume that cost of goods sold to sales percentage will be 75% for the next 4 years. Hence, the forecasted cost of goods sold is 75% of the forecasted revenues. Subtracting the forecasted cost of goods sold from the forecasted revenues gives us the forecasted gross profit. The selling and administrative expense percentage has declined slightly from 19.3% of sales in 2010 to 19.1% in 2011 to 18.9% in 2012. Walmart has exhibited strong cost control over the years and is likely to continue to exhibit such control. Assume that selling and administrative expense will continue to average 19% of the sales for year plus 1 to year plus 4. Hence, the forecasted SG&A expense is 19% of the forecasted revenues. Subtracting the forecasted SG&A from the forecasted gross profit gives us the forecasted operating profit. Walmart earns interest income on its cash and cash equivalents accounts. The following exhibit presents the asset side of the balance sheet for Walmart. The average cash balance for 2012 is $7,781 plus $6,550 divided by 2, or $7,165.5. The average interest rate earned on the average cash balance in 2012 was interest income of $187 divided by the average cash balance of $7,165.5, or 2.6%, which is similar to rates earned in 2010 and 2011. Assume that Walmart will earn interest income based on a 2.6% interest rate on average cash balances calculated as the sum of beginning and end of the year cash balances divided by 2 for the next 4 years. Projecting the amount of interest income requires projection of cash balance on the balance sheet. To do that, we first forecast total assets using historical growth rate of 5%. Applying 5% growth rate gives us the following forecast for the total assets for the next 4 years. Cash and cash equivalents are 3.8% of the total assets in 2012. So the forecasted cash and cash equivalents are 3.8% of the forecasted total assets. Finally, the forecasted interest income is 2.6% of the forecasted average cash and cash equivalents. Walmart uses long-term mortgages to finance new stores and warehouses, and short-term and long-term debt to finance corporate acquisitions. The following exhibit presents the liability side of the balance sheet for Walmart. The interest-bearing liabilities includes notes payable and short-term debt, current maturities of the long-term debt, and long-term debt. The interest-bearing liabilities for 2012 are $6,805 plus $5,914 plus $41,417 or $54,136. Similarly, interest-bearing liabilities for 2011 are $4,047 plus $2,301 plus $47,079 or $53,427. Hence, the average interest-bearing liabilities for 2012 are $53,781.5. The average interest rate is the interest expense of $2,251 divided by the average interest-bearing liabilities of $53,781.5 or 4.2%, which is similar to interest rate for 2011. Projecting the amount of interest expense requires projection of the interest-bearing debt accounts in the balance sheet. We already forecasted the total assets. Total interest-bearing liabilities for 2012 are 26.65% of the total assets. Similarly, total interest-bearing liabilities are 27.62% of total assets in 2011. Assuming the forecasted interest-bearing debt of 27% of the forecasted total assets, the following are the forecasted interest-bearing liabilities for the next 4 years. Finally, the forecasted interest expense is 4.2% of the forecasted average interest-bearing liabilities. So, adding the interest income and subtracting the interest expense from operating income gives us the income before tax. Walmart's average income tax rate as a percentage of income before tax has been roughly 32% during the last 2 years. Assuming that Walmart's effective income tax rate remains a constant 32% of the income before tax, the following are the forecasted income tax expense for the next 4 years. Subtracting the tax expense from the income before tax gives us the net income. Non-controlling interest shareholders in Walmart subsidiaries were entitled to $757 million worth of share in Walmart's 2012 net income, which amounted to roughly 15.4% rate of return on the investment, which is calculated as $757 from the income statement divided by average non-controlling interest from the balance sheet of $5,395 plus $4,446 divided by 2 or $4,920.5. Non-controlling interests are 2.66% of the total assets in 2012. So the forecasted non-controlling interest is assumed to be 2.66% of the forecasted total assets for the next 4 years. Finally, the portion of net income attributable to non-controlling interest during the next 4 years is 15.4% of the forecasted average non-controlling interest from the balance sheet. Subtracting this number from the forecasted net income gives us the forecast for the net income attributable to common shareholders. From the cash flow statement, we find that Walmart has paid $5,361 as cash dividends in 2012, which are approximately 32% of the net income attributable to common equity, which is similar to the payout ratio in 2011. So our forecast for cash dividends are 32% of the forecasted net income attributable to common equity. Cash flow statement also reports that Walmart also paid back to shareholders in form of share repurchases. Share repurchases are difficult to forecast, and for the purposes of this semester, we'll assume that Walmart will continue to buy back the same amount of stock as it did in 2012, that is $7,600. So the total forecasted dividends are the sum of forecasted cash dividends and forecasted share repurchases. In this video, we learned how to forecast income statement for the finite period future. In this example, we forecasted Walmart's income statement for the next 4 years. But a firm has a perpetual life, so we will need to forecast a long-term growth rate. Please review the video on revenue forecasting for further guidance.